The passage of this One Big Beautiful Bill Act is going to affect you, and you've likely spent the last few days trying to make sense of exactly how. The government is talking about a new $6,000 tax deduction for seniors, but what they're not explaining is how this temporary change creates a golden window of opportunity for your Roth IRA conversions. So I'm going to break down exactly how you can use this new law to potentially save thousands in taxes on your retirement savings, but you have to act before this window closes. This isn't just another small tweak. For the right person, this is a strategic opportunity. But for the unprepared, it's a minefield. We're going to explore what the new law says, where the hidden traps are, and how you can take advantage. Section 1, the new law. A $12,000 gift for seniors. Okay, let's start with the basics. Buried inside this massive new bill is a brand new temporary deduction available specifically to taxpayers who are age 65 or older. This isn't a credit, it's a deduction, which means it lowers the amount of your income that's subject to tax. And the amount is what makes this so significant. It's for $6,000 per qualifying person. So if you're single and over 65, you can reduce your taxable income by an extra $6,000. If you're married filing jointly and both of you are 65 or older, that doubles to a massive $12,000 deduction. Now, the best way I could think of to make sense of all of this was to draw this out. This new deduction stacks right on top of your other standard deductions. Let's look at 2025. For a married couple, both over 65, the combined standard deduction and existing extra old age deduction is $34,700. This new law adds another $12,000 bonus on top of that. That is a staggering $46,700 in total standard deductions. That's nearly $50,000 of income you can just wipe out so that it isn't taxed at all. But this is a significant stopping point. You have to understand this piece. This new $6,000 or $12,000 bonus is an additional standard deduction. What that means is you can only claim it if you take the standard deduction. If you are someone who itemizes your deductions, maybe you have large mortgage interest or state and local tax deductions or make large charitable contributions, you cannot claim this new bonus. This strategy is specifically for those who take the standard deduction. And there's a catch. This benefit is temporary. The law says this new senior deduction is only available for 4 years, 2025, 2026, 2027, and 2028. After that, it's gone. That 4-year window is the entire playing field. Section 2, the hidden catch. Why this deduction isn't so simple. So a 4-year window to claim up to a $12,000 deduction. What's the downside? Well, the complexity is in the fine print, with income limits called phase-outs. This is where the simple gift turns into a puzzle. The full deduction is only available if your modified adjusted gross income, or MAGI, falls below certain lines. For a single filer, that line is $75,000. For a married couple, it's $150,000. The moment your income goes $1 over that line, the deduction starts to disappear. And the phase-out is what makes this so dangerous. For every single dollar of MAGI you have over those thresholds, you lose 6 cents of your deduction. Think about that. This is effectively a 6% surcharge or a stealth tax on every dollar you earn inside that phase-out range. Let's trace it. For a single filer, the deduction shrinks and is completely gone once their MAGI hits $175,000. For a married couple, it starts disappearing at $150,000 and is gone by $250,000. This creates a dangerous no man's land for your income. This is particularly dangerous for retirees because your income isn't always smooth. You might need to sell a stock or take a larger withdrawal from your IRA to cover a big expense. These lumpy income events can easily push you over the threshold. Imagine a couple with an income of $140,000. They think they're safe, but they sell $20,000 in stock, pushing their MAGI to $160,000. They are $10,000 over the line. They will now lose $600 of their deduction. It might not seem like a lot, but a bigger withdrawal could wipe out the entire thing. costing them thousands in unexpected taxes. This is the trap. Section 3. The golden window of opportunity. Your Roth conversion strategy. If this deduction has such a dangerous catch, how is it an opportunity? It's because this deduction, with its clear income lines and temporary 4-year life, creates the perfect setup for a Roth IRA conversion. A quick refresher. A Roth conversion is when you move money from a pre-tax retirement account, like a traditional IRA, to a post-tax Roth IRA. You have to pay income tax on the amount you convert today. The massive benefit is that once it's in the Roth, it grows tax-free, and all your withdrawals in retirement are 100% tax-free. Now, let's connect the dots. The new $12,000 senior deduction lowers your taxable income. It creates a bigger space in your current tax bracket that you can fill with other income. What this leads us to is a clear strategy. You intentionally convert an amount from your traditional IRA to a Roth IRA, and the big new standard deduction helps absorb the tax impact of that conversion. You're moving money from a forever taxed account to a never taxed again account without a huge tax bill today. But it gets better. This can also help you manage your income to stay below the cliffs for Medicare Part B and D premiums. As you know, if your MAGI from 2 years prior is too high, you get hit with IRMA surcharges. This new deduction can be a powerful tool to help you perform conversions while staying under those IRMA thresholds, potentially saving you thousands a year in healthcare costs. You can't control the stock market. You can't control inflation, but you can control how much you convert to a Roth each year. This new law gives you a clear target to aim for between 2025 and 2028. If you're finding this breakdown helpful and starting to see the possibilities, take a moment to subscribe to the channel. We geek out on this stuff to help you turn new laws into new opportunities. We're all retirement nerds here. Section 4. Let's run the numbers, a real-world example. Theory is great, but let's draw this out. Let's meet Bob and Sue, both 67. They have a $500,000 traditional IRA, and they know RMDs are a tax bomb waiting to go off. Their annual income is $90,000, and they file jointly, taking the standard deduction. Scenario 1. Life before the new law. Without the new law, their tax situation is straightforward. They pay their taxes, but they worry about that big IRA and the future tax hit from RMDs. Scenario 2. The new law arrives, but no action. It's 2025. Their income is $90,000, well below the $150,000 phase-out cliff. They are eligible for the full $12,000 bonus. Their total standard deduction is now a massive $46,700. This immediately lowers their tax bill, which is nice, but they've done nothing to solve their long-term IRA tax bomb problem. Scenario 3. The strategic Roth conversion. This is where the magic happens. Their advisor points out their $90,000 income puts them in a low tax bracket, and they have the full $12,000 deduction available. They decide to be proactive. They perform a Roth conversion of $40,000. Let's look at the math. Their income for tax purposes, their MAGI, is now their original $90,000 plus the $40,000 conversion. That totals $130,000. This is still safely under the $150,000 phase-out cliff, so they get their entire $12,000 bonus. While they have to pay tax on the $40,000 conversion, their huge $46,700 standard deduction means they can absorb that income while staying in a low tax bracket. They've successfully moved $40,000 to their tax-free Roth. If they repeat this for 4 years, they could move $160,000 into their Roth, dramatically shrinking their future RMDs. Scenario 4. The danger zone. Getting greedy. Now let's see what happens if they get too ambitious. They decide to convert $80,000. Their MAGI now skyrockets to $170,000, $90,000 income plus $80,000 conversion. This is a disaster for 2 reasons. First, their income is now $20,000 over the $150,000 phase-out line. They start losing their deduction. $20,000 times that 6% phase-out rate means they lose $1,200 of it. Their big $12,000 deduction just shrank to $10,800. Second, that level of income likely pushes them into a higher tax bracket. The smart tax move just became much more expensive because they flew too close to the sun. This is a game of precision, not brute force. Section 5. Key takeaways and strategic planning. So, what are the key takeaways? First, you must plan your conversions annually. This is a 4-year opportunity. Spreading conversions across those 4 years helps you manage your tax bill and stay under the income cliffs. Second, this is all about bracket management. You need to know the tax brackets and use this new deduction as a tool to strategically fill up your lower bracket with converted Roth money. And third, you have to monitor your MAGI like a hawk. Before you sell anything or make any move that creates income, you need to know exactly where you stand relative to those $75,000 and $150,000 cliffs. The new tax law has opened a powerful but fleeting window of opportunity. For the next 4 years, you have access to a deduction that, if used correctly, can power a massive Roth conversion strategy. It's a chance to take control of your financial future. But as we've seen, it's riddled with traps. This can be complex, and getting the numbers right is critical. To help you get started, we've created a free tax planning worksheet that walks you through estimating your income and the space you might have for a conversion. You can download it for free using the link in the description. By the way, if you're leaving a comment, let me know you watched the whole video by including the secret code word, Golden Window. If you got value out of this, please consider subscribing to this channel. It helps more than you know. Don't let this 4-year window close without taking action. For more on this, I recommend this video for you to watch next. I will see you over there.